as you know, part of what we do, especially starting out, was more sales than financial advising. So in order to get through to people and to get them to get your message, you've got to talk like they talk. So sometimes you've got to use their vocabulary and reflect that vocabulary back to them because that's what they're hearing. That's what they're listening to.
Hello and welcome to Un-F Your Finances podcast with your host, Nick St. George. I'm your podcast producer, RJ Malik. Nick, good to see you, and I like the look.
It's Tracksuit Mafia. I got my Sunday best on for the Legend of Tracksuits of LinkedIn. I had to do it. Now I guess I could deduct all these tracksuits I have as a business expense, but we'll see if that will get me in trouble with taxes, and that's what we're going to go with. This is going to be coming out in February when everyone's asking about their tax forms. I literally got my first question for where my tax form is on Monday, the 6th, January 6th, which is a new record. So might have to send that client a gift. But more importantly, I got a guest. I got the legend of social media, Mr. Anthony Ruffalo. He's CFP, LPL advisor. And back in 2019, one of the first people I started doing videos and not just putting little blog posts on LinkedIn. He's been one of the inspirations for all that. For a lot of what I've done, the podcast, the videos, and all that fun stuff. Anthony, thank you for joining me.
I would say it's a pleasure to be here, but then I'd have to go to confession. I'm just kidding.
Come on, this is my Sunday best.
Listen, I saw, first of all, you're a tracksuit guy, so that's first and foremost. So I love we can discuss where that even came from. And then two, the title of the podcast, I was like, this is perfect. Un-F Your Finances is amazing because we're behind closed doors. When you're one-on-one and you're with a client, I would say 98% of my individual clients, they'll drop an F-bomb. It's because you're dealing with really intimate, emotional feelings, and you're working with people for years. It becomes more of a familial, a very friendly relationship. And that's what you're doing. You're completely un-effing their finances.
Correct. They're amazing people in their industry, super smart, super successful, but they don't know what they don't know. And I'm not here to sugarcoat it or be perfectly PC. Sometimes you got to be brutally honest. We're not in the yes business. There are times that I don't enjoy telling somebody, hey, you can't retire. Hey, you shouldn't buy this. But sometimes we got to help them from hurting themselves. Do you ever want to retire? You got to stop doing this. Stop fucking around. This literally, all the planning, all the effort, all the saving, all the changes, you're going to literally light it on fire over one emotional decision. So yes, swearing is part of it. At a kitchen table with a client, they've worked hard all day. They got family, kids, whatever. They're going to drop an F-bomb. They want to know what's going on. Hey, the world is fucked up out there. They're going to say it. I'm going to say it.
It's the truth, and it's the reality of how it goes down behind closed doors. And, one of the things that I like about being an entrepreneur and an independent business owner is that we have a little bit more of that latitude to get more intimate and one-on-one with people. And we don't have that corporate veil that we have to pretend, to be under. Now, to some degree, you do it tactfully, and you don't want to get you don't have to necessarily get like George Carlin with it with the seven words that you can't say on TV, which I'm not going to go over all those words. But that's just the reality of how it really goes down when you're dealing with emotional situations. And sometimes, as you know, part of what we do, especially starting out, was more sales than financial advising. So in order to get through to people and to get them to get your message, you've got to talk like they talk. So sometimes you've got to use their vocabulary and reflect that vocabulary back to them because that's what they're hearing. That's what they're listening to.
You got to find a way to relate with them. If you can't get on the same level, same wavelength, you could have the greatest answer, greatest strategy. If they can't wrap it around in their terms, they're not going to listen.
It's called, so there's part of being a financial advisor, and I see a bunch of these younger guys poking around on LinkedIn and social media, and there's they're like, you could tell they're just like total nerds, like by the book, and they're great planners. But it's like, have you actually had a conversation with a human being before, like face to face, or do you just recite IRC tax code? Like, yeah, you're right, but you're never going to motivate anybody to actually take action to do anything unless you learn how to interface with, I don't know, a human being.
I have a good friend. We grew up together, went to college. He's a CFA, actuary, Rain Man with numbers. And he's like, oh, you should hire me to talk to people. I'm like, most clients don't even know what a CFP is. I can't allow you to sit down in front of somebody. Like, you're going to sit there and start rattling off beta, sharp, and all this other stuff. And their eyes are going to glaze over. It's going to mean nothing. And they're going to walk out of there and not listen to, they don't know what, like, you're too smart to be in front of a client.
Yeah.
Like, not saying he couldn't do it. You get those engineers that probably eat it up. But other than that, like, they need to understand it. You got to break down. You can't just recite, to your point, recite the book. You got to relate. You got to break it down. But at the same time, you can't just be a strict salesman. Like, you can't just sell all sizzle and not understand it. That's why having your CFP matters. But I tease people. I'm like, the behavior. If I can get you in the psychology, get your mind right. Money's emotional. Money makes you do stupid things, family fights, steal, whatever. It's a very, very hard topic to rationally think about. Go back to COVID. The market goes down, what, 30, 40% in 30 days.
Yeah.
People are ready to jump off of that airplane in the middle of some turbulence.
Well, fortunate for me, I've had, so this will be my 20th year in business. So I was probably about 15, 16 years in around COVID. And I think it really takes about a good 7 to 10 years to have that solid relationship with clients where they really begin to trust, and they really trust you, and they trust that, like, you've demonstrated results like over the years. So I got to tell you, during COVID, I had some people that were like a little bit, and I was legitimately nervous myself, because I was like, all right, are we really legitimately about to have 10% of our population wiped out by this thing? Like, I was watching the John Hopkins, like, death toll ticker running up and down, and that thing scared the shit out of me. I was like, oh man, it's coming, it's getting worse. But after we got into it and realized, like, all right, it's not that bad, I was actually more freaked out when I was watching the Italy death toll ticker, because I'm like, their mortality rate was like 11%. I'm like, I'm Italian. I'm like, I'm toast. Like, there's something in our genetics. COVID's got us.
I just remember having to go down like the aisles, and you got people in snorkel masks. You go down the aisle this way, and you get home. I'm like, I got to strip down to my underwear and wipe it all down.
I was in Harris Teeter, and there was a guy in full scuba tank, mask, snorkel I thought I was in a sci-fi movie. I was like, is this where we're at right now?
It's like, where's the hidden camera? They're definitely watching me. They want to see what I do. He's going to bump into my cart. Do you walk up to him and pretend to sneeze?
So the point, I was going to land the plane on my point, was during COVID, I had that relationship, and more of the phone calls I had were people saying, I've got cash I want to put to work. What's the best way for me to deploy it? It wasn't what you may think, or what a lot of people may think, was, I want to get out of the market because I'm panicked and I'm terrified. It was, I think they see the opportunity. We've got a track record of trust, and they know it's either like, hey, either this is going to be it and we're all toast, or this is opportunity and I want to deploy some cash.
I'd say I had about 40% that were like, hey, shit's on sale. 40%, all right, you told me dips can happen. I hate this, but we're okay. And then 20% are like the ones, oh, it feels like we're on the Titanic. When will this stop sinking? Like, how am I going to survive? And I'm like, and kind of brought it up, like, if this continues on this path, like, I don't care if your money's in a coffee can or not, we're all toast. Like,
yeah.
But to your point, the longer you've gone, the more that they've weathered that with you, and how you explain and relate. And I don't know, doing this podcast, doing emails, doing videos, you want to be the messenger. In today's day and age of nanosecond news, beating them over the head with negativity, you got to be that kind of calming voice in all of it.
Well, so one of the things that I really like, I've struggled to articulate, that I heard Josh Brown put into words. He's such a good writer and he's such a good speaker. And one of the things that he put into words that I couldn't articulate was, it's kind of like, he calls it the perpetual stop loss. And if you read his book, he talks about that. And it's like, the market always seems, it just always seems to rebound. But why is that? And it's because we've moved past that traditional industrial manufacturing economy where you have that classic business cycle that we learned about in economics 101 of expansion, plateau, contraction, recession, job loss, 2 to 3 years in a, extent, so on and so forth. The last kind of cycle we saw like that was the great GFC 08, 09, which was really kind of like an outlier event. And it's more about, we've moved towards a service-based economy, which we just have to kind of work through these exogenous shocks that interrupt our markets. We get these dips, but the market is like, it's the fabric of society right now. It wasn't like that 30 or 40 years ago. The 401k came out in 1980 and it's democratized. So we've really only been putting money away on a democratized basis, the middle class, for about 40 years. It used to just be like the market used to be for the rich. Now it's, hey, everybody has a 401k. Everybody knows, the thing goes up, the thing goes down. But over time, we do like 7-8%, something like that. I don't even look at it anymore. People don't worry like they used to worry anymore. So, and that services-based explanation really kind of solidified it. And we just have to work through these exogenous shocks.
Yeah. And you get service, you have efficiencies with the AI and stuff like the old, like some of those old economic indicators, cost of goods sold and like your inventory numbers. It's like, how do you properly quantify Google or something like that? And some of this cloud stuff. And it's just like, we're becoming more efficient. We're becoming like I don't know. I think it's pretty exciting to see what happens, how they can make things more productive, more growth, more just all of it. So we're shooting this now. It's early January. This will come out in February, which is typically that wheelhouse of all the 1099s and all the other documents and letter soup of IRS forms. As I said in the intro, I've already got one question where the 1099 is. Talking about uneffed. Some of this stuff, you get these clients, a lot of times when you get the self-directed people coming in, they fuck something up. Or they hit that pain point with their business or something else like that. And that's where tax comes in. We're not tax advisors, but I use Holistiplan. You partner with CPAs. Like it really helps demystify some of the stuff. But I don't know, what's one of your bigger pain points? You walk into a newer client that maybe isn't used to having that whole plan with you. What's one of those, what jumps out at you or top of mind of, hey, what's a pain in the ass for taxes for the average person?
I mean, there's just so many different examples that you can give. I mean, number one, first and foremost, is locating and accounting for just something as basic as your 1099s and actually gathering up all of the documents that are needed to file taxes properly. So I would say the first step in uneffing your finances is making sure that you have a simple checklist of what you need to file your taxes and not relying upon your accountant to ask you for the checklist. So I would ask your financial advisor, hey, what do I need as far as a check? So and when I say checklist, I mean a 1099 from this account number, a 1099 from this account number, a 1098 from this, a such and such from, my social security, so-and-so, my W-2, my 1099 from here, my hustle, my outside, whatever, and having a very simple checklist of, your 2 to 15 different documents that you got to make sure that you have in order to file your damn taxes.
You can't count on the CPA. They don't know that you opened up a crypto account somewhere. They don't know that you are now part of some rental property group, that you get some passive income. Like they don't know to ask for that. They're going to say, hey, is this all your documents? And leave it that broad.
When you work with a CPA, you sign an engagement letter that says, to the best of my knowledge. That's his CYA saying, hey, if they didn't give it to me, I didn't know about it. So it's like healthcare. You have to advocate for yourself. All the professionals that you work with are making you sign disclosures to cover themselves. So if you truly want to be uneffed on your finances, you've got to take the time to make a list of your income sources and your 1099s. You cannot rely upon anybody else to do it.
Yeah, that is huge, I would say.
Tremendous, some would even say.
Another thing you run into even with newer clients, the first couple of times you do it, tax loss harvesting. Like the best way I've tried to explain it is it's the Bed Bath and Beyond coupon. You can use it if you don't want to, but like how many people forget that, or they don't want to sell something that's down. Hey, why take this loss? It's going to come back. Oh, it's eventually it's going to get there. Like, how do you handle that with your clients?
Well, I'll tell you exactly what I do is I don't discuss it. I manage assets. 99% of what I do is on a discretionary basis. And we discuss it in our upfront strategy meeting. We discuss it at our annual reviews. But when you see me make a trade in your account, I don't have the time to call everybody and discuss every trade and give you the rationale. If I'm making a trade in your account, it is because it is in your best interest, and I'm a professional and I know exactly what I'm doing. At the end of the year, if you ever have a question on a transaction, absolutely you call me and you ask me what's going on, and I'll explain exactly why I did that and why it's in your best interest. But I don't have the time to call everybody and explain it. I just do it. And if the market's on a, like if you're on a dip, you may only have a couple of days to swap Coke for Pepsi, to swap VOO for IVV. Like you only have a limited amount of time to get those individual tax loss trades in order to harvest and take advantage. Then we discuss those at the annual review and we say, hey, this one and a quarter, what you're paying me for, this is what I'm doing behind the scenes. I'm not just resting on my laurel, fat and happy,
Fluffy.
riding the gravy train, collecting the fees.
Easy on the F word. It's fluffy.
Fluffy. This is what I'm doing behind the scenes.
And discretion makes the world go round. We can't explain every trade. It was more of on that back end of, hey, at the end of the year, I had a couple of years ago, client CPAs like, you need to get a new advisor. And they're like, oh, we're down all this money. It's like, no, we're up on the year, but I generated losses. Like I earned my fee in multiples of ways. And that's one of those things of, hey, to your point, it may only be it could be a 10-day period. Think about what this year, we had the carry trade during August, that was a nice little pop right there. You want to grab a couple losses, you quickly get in, get out. But if you have to go and call them and explain it, but at the end of the year, they're going to thank you.
Yes, absolutely. And yeah, to your point, exactly what you were saying. I have had to have that conversation where clients like, hey, we have 18,000 in losses in the account, but we grew, by 40, we grew by 48,000. We're up 12.5%. How does that work? And then you got to go back and you got to explain, well, listen, you never want, I'm not timing the market, but we're taking advantage of what the market gave us. And we just, we swapped the position, but we didn't get you out of the market.
Correct. We're not going to go run to cash and hide and stick our head in the sand. How much have you dealt with the donor advised funds? That's one of the things that seems to be like the hot topic, or the charitable giving, playing around with, hey, will the tax code change this year? Because that's one of the things we always forget. Like, it seems like the tax code changes roughly every 2 years. There's always a new wrinkle, some little change. What's been your experience with that?
Maybe 3 people with donor advised funds.
It's not huge, but when it hits, it's a winner for.
It's typically the one I inherited, and but 2 I inherited and 1 I helped set up from scratch, and it was like 3 years ago, and it was an unexpected multi-million-dollar W-2 income year, and it was like the perfect year to execute it and put it in place. Work with the CPA, and they're high net worth people, 20 million plus. So for them to put $1 million in and fund it out of the gate was perfect. It was perfect timing. It just, everything lined up for them.
The crazy part on this is like, that's a perfect thing. You get the huge W-2 income. You can't really hide that any other way. There isn't like some write-offs or stuff for like, hey, we're running our own business. 1099 is a little bit different. Your W-2, there's not a lot of ways to write it off. But the crazy part is I find like people that, hey, they're making AGI is 150,000. Hey, should we do this to lower? It's like,
yeah,
where did you get? They're getting pitched from that. I don't know. It's all. I always find it crazy on some of the things that are getting pitched to households that are lower. Like, oh, we need to have this.
No.
To your point, it's a very finite little window, but when it hits, it's a tremendous tool to have.
Yeah. I'll give you a simple one that I think an average ordinary person, like more of your middle class, $200,000-$300,000 earner could relate to. One I see a couple times a year is they've got accounts and they're contributing to a tax deductible IRA, and they are also covered by a 401k at work, and they're phased out. Simple one. I see it a couple of times a year. So to qualify that is, the income limit. So if you have a 401k and you're covered at work by a 401k, the income limits for you're disqualified. The IRS disqualifies the deductibility of a contribution to a traditional IRA in addition to your 401k contribution. And I don't know the exact, I think it's around like $60,000. So if you make like over 60,000 married filing joint, that's it. You can't put any deductible money into it. I see that one constantly. People can over contributing to retirement accounts.
And then having to back out that return of excess contribution. That's always a fun calculation. And especially if it's been a year or two. And this goes back to those 1099 forms. What if you've been making those contributions, didn't tell your CPA about it, and then 3-4 years later, it finally pops up? Or where is that? Like, that's one of those things, like, you got to be forthcoming. Oh, I made a contribution. Like, I don't know, my CPA gives a checklist. Did you make any contributions? Did you buy any businesses? Like, some of those things that kind of get you thinking in that way. But
I'll give you another one. 2 guys in my own neighborhood who I don't work with. They're not my clients, but they ask me for, how the people ask you for advice. And I'm like, listen, I'll help you if you want. And then they don't take it. They got advice from their CPA to do the backdoor IRA conversion. I take a look at what they have. All the money is sitting in a non-deductible IRA that's never been converted. So they got half of it done, but they never.
Oh God.
They never did the second part, which is convert to Roth. And then they never invested the money.
It's still sitting in cash.
It's like, but no, I'll DIY it.
Yeah, exactly. No, I got this. True wealth is not being able to have to YouTube any fixes around the house.
No, my definition of wealth when I was striving towards when I was younger, I just wanted to be able to shave with a brand new Mach 3 razor every day.
I like it. Wealth to me growing up was like my friends that had the pool table in the basement. If you had a pool table, you were rich. Like, that was.
Oh yeah.
Like, those are the big
2-story house. Kid,
yeah.
Killing it. Colonial. You had stairs in your house?
Yeah. Like, that's wealth. It's funny hearing, like, talking to my kids now of like, hey, what's wealth? And they're like, oh, this kid has this. And I'm like,
yeah, my 8-year-old daughter, it's like, Dad, can I have $40? Because I want to add to my skincare routine at Ulta. I'm like, you're 8.
Oh yeah. What is it? Sephora? Is that the other one?
It's because they watch YouTube and they're brainwashed by YouTube. Anyway, all right. So let's keep going. Let's knock out a couple more.
How about RMDs? Now we're going to what? 73? It went from 70.5 was always the weird one. No, you got to calculate it. No, it's there. We got the 10-year rule, all that fun stuff on inherited ones. The inherited IRA. My call this morning, inherited IRA, was panicked that his mom passed away 58 days ago and he had to do something. I was like, no, that's 6 days for a rollover. You inherited. Like, you get time to grieve your mother. Like, it's okay. Mm-hmm. And they were adamant. They're like, well, if I don't do something, I'm going to get penalized. And I'm like, this is the problem with Googling. They Google the IRA and time and they see 60 days and like Google and what is going on with yourself, your taxes, your situation. They don't always, they might give you the buzzword, but this guy was like literally panicked on a family vacation, no less, that he had to do something like in the next 24 hours or the Club Fed was coming for him.
Yeah. I'd also ask, well, if you knew it was 60 days, why are you on day 58, buddy?
Hey, I don't know.
And why is your lack of planning an emergency on my part?
This came through a buddy of mine Saturday night, 10 o'clock, text me. He's like, can you talk to him? I'm like, I'm on my 4th bourbon. You do not want me talking to somebody at 10 p.m. on a Saturday. I'm like, I'll talk to him. But yeah, to your point, you waiting to the last minute, there's nothing better than that April 15th. I need to open up an IRA or I need to open up a SEP or can we do this? And it's like, poor planning on your part is not an emergency on mine. How about wash sale? You get the do it yourself investor. They think they figured out the algorithm of day trading one of the magnificent sevens, and then they get their tax bill with the netted out 1099.
Yep.
So wash sale, basically you can't buy or sell the same security in 30 days. Now, Coke and Pepsi, even though they're both soft drinks, that is different. But you get the people that fall in love. You see those day traders that do it themselves. So they're over there on Robinhood. They find that one stock and they fall in love with it. And they just, oh, it's volatile. I'll buy it. I'll jump in, jump out. And that's a nice little surprise. Or my other favorite one, and we're getting towards time. The people that want to they take the risky assets and put it in the IRA and then think they can deduct the losses. Now, years ago, there was a little bit of a clause you could do that. They've closed that loophole. But there's something said for where you position your assets, where you're taking chances. I'm not saying you're going to be ultra safe in your IRA, but if you're going scratch tickets, I do at least do it in a taxable account. So if it blows up, you have something for it.
Yeah, you have some ability to deduct some losses.
But no, it's one of those things. It's everyone thinks you're too expensive or they can do it on their own until like they get punched in the mouth. Everyone's got that plan until they get punched in the mouth.
The wash sale rule that'll surprise a lot of people if you don't know what you're doing. You can't trade in and out of a security within 30 days. So for example, if you buy Coke and you lose, $10,000 on it, goes down $10,000, and you're like, hey, I'm going to sell it right now, take the $10,000 loss, and you have got to wait 30 days or 31 days before you can buy it back and still capture that $10,000 loss. And that's just a real simple, little gotcha, little trap that some of the DIY day traders fall into.
Yeah. And then I'm gonna end with this. I've watched enough of your stuff. I'm pretty sure we're similar on the planning. Like I started early October. Let's do some year-end planning. Let's look at that tax return. Everyone's like, oh, I have a CPA. When we do the tax planning, we're looking forward through the windshield. Your CPA look through the rearview window of what happened. They're filing it for you. But one of the bigger things, like, hey, can we take some extra money out of the IRA? What's your tax bracket? What is your income? What should you make this charitable deduction? I think one of the bigger things that people understand is they want to do tax planning in March when the CPA says, hey, you owe $15,000. You really got to do that tax planning September, October, November, because December's a shit show with holidays and parties and gifts and everything else like that. That October, November time period, like that is your wheelhouse to really get things done and save you before March hits you.
So I might have my practice kind of broken into two different categories: accumulators and decumulators, because they have different sets of needs. And I communicate to them differently throughout the year based on proactive tax planning needs. Around September is when, for my accumulators, is when I'm making the push to look at, because we know what total income is going to look like for the year. We're looking at IRA conversions. We're looking at IRA contributions. What are you phased into? What are you phased out of? What should we be doing towards year end? Truing up some of the safe harbor estimated quarterly tax payments on some of the self-employed people that we kind of help out. We're looking at things like that. Perfect example, today I had new clients in the office and they're high net worth people. And I took the time, I did the holistic plan report, and I just simply went over here's your total income, here's your AGI, here's what a standard deduction is, here's what itemized deductions mean. And this is what you've been doing. You've been itemizing. It's a bigger number. Here's your total federal taxes that you paid. Here are your total state taxes that you paid. Here's what a marginal bracket looks like. You're not paying 32% on all of your income. You're paying it in marginal increments. I show them the chart and I go over literally an educational process into the US tax code, capital gains, the brackets, 0, 15, 20, netted investment income tax at 3.8. We just went through all of it. And I just gave them a brief education on their specific situation, and then follow that up with, hey, it is January of 2025. Tax planning for 25 starts now. You're used to working with a CPA, and a CPA is tax preparation. Tax preparation is very different than tax planning. Tax planning is what you really need and what everybody thinks an accountant is supposed to be doing for them. However, very few accountants actually do tax planning. They're just doing tax preparation. And when you put it to them like that, the light bulb finally goes off and they're like, oh crap, like now I get it. Now I finally get it.
No, that's a great way of breaking it down, because they're going to prepare it, but like 25 preparation starts now. How they do it, what do they do with their quarterlies, all of it. Like that's a really good way of explaining, because everyone thinks, oh, I have a CPA. Well, there are great CPAs out there that do tax planning, but hey, with holistic plan, you go through that makes all those forms digestible. Like my 10-year-old can kind of read through one of those reports. Oh, I get this. I see the chart. Oh, I don't, to your point, everyone talks, oh, it got bumped up to 32%. It's like, yeah, on that last 40,000, everything else, your effective tax rate, you're at 17.1 was your average across every dollar.
Yeah, it was my what in 2019 was the first video I ever did on like LinkedIn or YouTube. And I did like 4 or 5 just because I'm like, I know I want to start, and they were terrible. And then it was March, it was end of March, and I was in my neighbor's driveway, and the 10-year-old kid is running around with a fireman's hat on. And it just dawned on me, I'm like, all I'm doing is putting out fires right now because they're like, oh, I was going out work and whatnot. So I was like, can I borrow that hat? So yeah. So I took the hat. The next day, I made a stupid video, a little 1-minute video wearing that dumb plastic fireman's hat. And it was about taxes and putting out fires and about proactive tax planning versus preparation. And that was like the first one, like that video. I'm like, I think I was getting like 50 or like 100 views, and that one got like 1,500 views. And I was like, yes. I'm like, this is amazing. I'm like, I figured the rubric. I figured it out.
Yeah, and I remember going back looking at my first couple of videos, and it's like my iPhone stacked on top of boxes on top of an ironing board, and the compliance back then wanted you to be verbatim. So I'm over there like reading it, like,
It's
duh,
horrible.
and it was just like so cringeworthy. And people are like, "Oh, you're good on camera." I'm like, "You got to suck to start." But I don't know. RJ's hitting me with a cattle prod. We're going too long, and as we talked about before, nobody wants to listen to two assholes talk this long, or at least one asshole. You're a gentleman.
Thanks.
But I appreciate you
mine.
coming on. This has been fun. Maybe we'll do it again. We might have to taste the rainbow with the tracksuits on future ones.
I got 38 more where this came from.
Challenge accepted.
Before you go, gentlemen, how about contact information so people can contact you?
I don't want anybody contacting me. No, I'm serious. I'm good.
He's good. He said it on. He's maxed out. So
Okay, Nick, how about you?
Nick at stgeorgewealth.com, Facebook, LinkedIn, and the website.
Nick, thank you so much. Looking forward to your next podcast. And thank you for listening to today's Unf Your Finances podcast. Please like, follow, and share this podcast with friends and family. Until next Unf Your Finances podcast, I'm RJ Malik.
Thank you for listening to the Unf Your Finances podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.stgeorgewealth.com or give us a call at 828-481-8836. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of St. George Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA and SIPC.
Any guests in their company or companies are not affiliated or endorsed by LPL Financial unless otherwise stated. Individual tax and legal matters should be discussed with your tax or legal professional. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.